Welcome to the Explainer. Today we're going to dig into AppFolio's latest third quarter results, and wow, is it a story. On the surface, you see this huge growth, but when you look a little closer, there's a really surprising twist when it comes to their profitability. We're going to break down all the numbers using insights straight from their CFO, Tim Eaton.
So, here's how we're going to break it all down. First up, the big headline numbers. Then, we'll dissect exactly where all that new revenue came from. After that, we'll get into the most interesting part of the story, their operating margin, before we look ahead at their updated forecast for the rest of the year.
Okay, let's just dive right in, shall we? Section 1 is all about those big, flashy numbers from their third quarter performance that really grab the headlines.
First up, the big number. The company brought in a total revenue of $249 million for the quarter. I mean, that right there sets the stage for a really strong report. But you know, that $249 million isn't just a big number in a vacuum. The really impressive part, it's a 21% jump compared to the exact same quarter last year. We're talking some serious momentum here.
And here you can really see it. This chart just lays it out perfectly. That jump from last year to this quarter's $249 million. I mean, that's what 21% growth looks like in action.
Okay, so a 21% jump is huge. But the big question is, where did all that money actually come from? In this next section, we're going to peel back the layers on that revenue number because it turns out it's not just one thing.
So, when you look at AppFolio's revenue, they basically split it into two main buckets. You can see the lion's share, a whopping $192 million, comes from what they call value-added services. And the other $54 million, that's from their core solutions.
So you're probably asking, what's the difference between these two? Well, it's pretty simple, actually. Core solutions. Think of that as the basic subscription fee you pay just to use the platform. But the value-added services, that's all the extra stuff, the tools customers use within the platform. We're talking online payments, tenant screening, all that good stuff.
Now, looking at that core solutions part of the business, the growth there was super healthy. It really came from three key places. One, they just signed up a bunch of new customers. Two, their existing customers started managing more and more properties on the platform. And three, a lot of clients decided to upgrade to their premium packages. All good signs.
And then you've got that massive piece of the pie, the value-added services. That grew because customers were simply using more of their tools, like for payments and screening. The CFO also made a point to mention that some new partnerships they have with companies like LiveEasy and Second Nature are really starting to contribute to the bottom line. Okay, so revenue growth is through the roof. Everything looks great, right? Well, this is where the story gets really interesting, because you'd expect profits to soar too, but that's not exactly what happened. And that brings us to the central question of this whole report. It just seems a little weird, right? If revenue shot up by 21%, why on earth did their profit margin actually decrease compared to last year? All right, first, let's just look at the hard numbers. Their non-GAAP operating margin was 23.5% this quarter. And when you compare that to the 28.7% they had a year ago, yeah, that's a pretty noticeable drop.
And here it is. Here's the twist. The reason the margin went down is because the company did too well. Seriously, they performed so well on revenue and bringing in new business that it actually triggered a bigger-than-planned bonus payout for employees. This was a $13 million expense they had to book in Q3, basically as a result of their own incredible success.
And get this. This is probably the most important number in the whole story. If you pull that one-time bonus expense out of the equation, what would the operating margin have been? About 29%. Not just better than last year, but higher. So yeah, it's what you'd call a good problem to have.
So, with this incredible performance under their belt, and even with that big bonus expense, AppFolio felt pretty darn confident enough to actually raise their financial forecast for the rest of the year.
So for the full year, they're now telling investors to expect total revenue to land somewhere between $945 million and $950 million. That is a big step up from what they were saying before. And what about the profit margin for the whole year? Well, they're expecting that to be in the range of 23.5 to 24.5%. And yes, that number includes that big bonus expense we were just talking about. So how does the CEO himself, Tim Eaton, feel about all this? Well, he summed it up with a real sense of pride, you can tell. He pointed straight to the company's innovation as the engine behind all this growth, and he's clearly excited to talk more about it.
And that really leaves us with a fascinating final thought, doesn't it? AppFolio's story this quarter shows that their own success created a pretty big expense. It just makes you wonder, when a company's success leads to higher costs, is that a sign of incredible strength, or is it a potential challenge down the road? Something to think about. That's all for this breakdown from the explainer.